Hey everyone, this is the Cash Money's channel. I'm going to go over a video for you today about investing for beginners. This is basically the first question we want to ask is what type of investor or trader are you? There's long-term investor, which is you hold stocks or index funds for greater than 1 year, or there's short-term investors, and that's if you hold stocks or investments for less than 1 year. And for index investors, there's two types of investors, an index investor and a stock picker. And sometimes you could be a mixture of both. And usually the short-term investor is usually a stock picker, but sometimes they do trade some index ETFs. So we're going to decide which type of investor is the right fit for you. So an index investor, usually an index fund, has multiple companies under one fund, and that's called an index fund. And there's many different types of index funds, small cap, mid cap, large cap, and I can go into those later if you have any questions about that. And usually what's so attractive about index investors is index funds have low fees, and they usually, when you buy an index, it you buy the price at the end of the day. There's also ETFs, which is exchange traded funds, and those are like an index, but you can buy it throughout the day of the stock market open to close. And there's also managed indexes, which has a manager, and they usually have a higher fee. But usually if you're an index investor, you want to choose an index with lower fees. I prefer the original index funds without a manager and without an ETF. Basically, those are basically like robo indexes, but it's not like the retirement indexes you might see with your 401k plan or other indexes that have like a year of retirement, like 2050 blah 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 index. Usually those indexes have higher fees than the normal indexes. So you always want to check the index fees, whether it's a managed index and whether it's an ETF index, whether you could buy it throughout the day or just buy it by the price by the end of the day. And then there's the second type of investor is a stock picker, and they could either be long-term or short-term. And there's two types of stock pickers usually. There's the stock picker that goes off of fundamentals. They review the company, they check their revenue, their PE ratio, which is profit over earnings. And then there's stock pickers that go off of technicals. Basically, they are experts at studying the charts. And a lot of times the short-term investor uses technicals. So the short-term investor, which is they hold stocks for less than a year, they usually sometimes day trade it, they swing trade it. Swing trading is maybe holding it for a couple of days, a couple of weeks, a couple months. I would say I'm a swing trader, but I have done some trades that I sell by the end of the day. But it's really what type of investor are you? And some people don't feel comfortable being short-term investors. Some people don't feel comfortable being long-term investors. So it just depends on what type of investor are you. Some people are a mix. I say I'm a mix. I like doing index funds for retirement, but I like picking stocks for short-term gains. And with short-term investors, they have different options. It's probably the more complex of the investors. They do options, shorts, and puts. I don't mess with that because usually that has higher risk. But a lot of the short-term investors, including myself, use technicals to study the charts, like Harami candles. And Harami candles, we can get into that later. It's just it's a way to tell whether the stock is going to go up or go down or go sideways. That's basically, and there's different patterns you can see in the charts they always repeat itself with different stocks. And for short-term investors, they always basically also look at the dips. Why is the company dipping? The news, and they usually start with a higher amount. Versus long-term investors, they just put in, they like dollar cost average, they put in money every so often. Usually the short-term investors have a higher amount saved up, maybe say $1,000, $5,000. They wait for an opportunity. When the stock is low, they buy it, they wait for the rebound, then they sell it. So they're more like opportunists. So I say I'm more of an opportunist myself. But usually before you become a short-term investor, you want to probably start out with a small amount of money, just to see. You want to get consistent gains. You want to make sure your technique is good. You don't want to put too much money on the line and then realize you're not following the technique, or you get nervous. Some people can't be a short-term investor because they have anxiety, or they get scared. So you have to really stay true to your plan. And that's another thing. I have a trade journal, so I always document in my trade journal, what I'm buying at, what price I'm going to sell at, and then the next and there's those topics you could talk about forever too. But if you have any questions or comments about me going further into any of those, just let me know in the comments below. And a lot of people ask me, which platform should you choose? I have Fidelity, Vanguard, TD Ameritrade, and Schwab. But the popular platforms that millennials use are Robinhood and Webull. First, you have to sign up for it, which is like signing up for basically like a Facebook account. But they ask you some information like Social Security, your bank information. Basically, you transfer money from your bank. You wait 3 days for your money to settle, or sometimes you could you don't have to wait for it to settle, but it'll trade. You could trade it right away. Just depends on which platform you use. When you sell a trade, you have to wait 3 days for it to settle before you could trade again. Otherwise, you might violate the PDT rule, which is basically like a rule to prevent you from day trading too much. They don't want to, PDT stands for pattern day trader, so they don't want you to basically trade in and out of an account if you're a new beginner. Basically, the only way to the only way for the PDT rule to not apply to you is if you have over $25,000 in your account every day. So, I mean, I don't know about you, but I don't want $25,000 in my account in cash all the time. I want to be investing that. So, so basically, you could probably do like maybe 3 trades a week if you short-term, like buying and selling during that day, without being labeled a pattern day trader. But before you do any of this, all this trading is through a taxable brokerage account. You want to make sure, first you invest for your retirement. I would always recommend people first, make sure you are investing in your retirement first, because as time goes by, all that money compounds. There's more tax incentives, and employers have good matching for 401k. Also, you could do your Roth IRA, an HSA, and also your employer might offer an ESPP, which is an employee sponsored stock purchase plan, which they could give you a discount for the stock. And I always would recommend to do that, especially if your company is a good company, and they have every year their stock is higher. Then that's a definite yes. So I'm sorry this video is bad. I'm just doing it on my iPhone and just beginning, but I just wanted to let you guys know. Have a great day. If you have any comments, just put down below and let's make some cash. All right, you have a great day. Bye.